For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. Palantir Technologies has experienced a remarkable rise in its stock price over the past 12 months, largely fueled by strengthening earnings, increased enthusiasm for artificial intelligence, and the election of a favorable administration in Washington. However, despite this momentum, not all market participants are optimistic about the company's future. Recently, an analyst from Goldman Sachs reaffirmed a hold rating on the stock, underscoring the idea that stocks experiencing rapid gains often face inevitable corrections. This perspective serves as a reminder that no stock can climb indefinitely without encountering resistance. From an investment standpoint, Palantir's valuation has become a point of contention. The stock's current pricing places it in a category that appeals more to speculative traders than to those who follow a value-oriented approach. When a company's stock price reaches levels that appear disconnected from its fundamental financial performance, it becomes increasingly susceptible to heightened selling pressure. Investors who have already profited, along with short sellers looking to capitalize on potential weaknesses, can exert downward pressure, leading to significant volatility in the share price. Palantir's valuation is among the most extreme in the market today. The company currently trades at an astonishing price-to-sales ratio of 97.9 times, which dwarfs the industry median of 3.3 times. This valuation premium of over 2,827% relative to sector peers is difficult to justify, even for investors with the most optimistic outlook. Similarly, Palantir's forward price-to-earnings ratio stands at an astronomical 225.5 times, surpassing the sector median by 775.2%. Such figures indicate that Palantir remains one of the most richly valued stocks within the artificial intelligence and technology sector. Even after experiencing recent pullbacks, Palantir's valuation remains significantly elevated. Looking ahead, projections indicate that its price-to-earnings ratio for 2025 is expected to gradually decline to 79.5 times by 2028. While this represents a downward trend, the company would still be trading at a considerable premium compared to industry norms. Furthermore, Palantir's enterprise value-to-sales ratio, which currently stands at 100.3 times, further emphasizes its high valuation. This figure exceeds the sector median by an astonishing 2,716%, reinforcing concerns that the stock price may be outpacing its actual financial performance. While the company's projected sales growth of 34.8% in 2025 is impressive, it does not sufficiently support its extraordinarily high price-to-sales ratio. Compared to other rapidly expanding technology firms, Palantir appears significantly overvalued. The company's strong position within the artificial intelligence industry and its potential to revolutionize data analytics remain attractive investment factors. However, given its excessive valuation metrics, investors should approach with caution. Across various financial measurements, Palantir consistently trades at a premium that is difficult to justify. The company currently holds the fourth highest price-to-sales ratio among firms, with a market capitalization exceeding $10 billion, further underscoring the extent of its elevated valuation. With such a high valuation, any external disruption or negative development could place substantial downward pressure on Palantir's stock price. This vulnerability was evident on Wednesday, February 19th, when a memo from Defense Secretary Pete Hegseth was obtained by the Washington Post. The document suggested that the current administration would pursue reductions in defense spending, a move that could have significant implications for Palantir's future revenue streams. According to the proposed plan, the US government intends to reduce defense expenditures by 8% annually over the next 5 years. Given that Palantir derives more than half of its revenue from government contracts, these budgetary reductions could pose a serious challenge to the company's financial stability. In fact, data reveals that Palantir has increasingly relied on the US market in recent years, with over 60% of its total sales originating from Washington-based contracts. If defense spending reductions are implemented across multiple sectors, Palantir could experience difficulties in securing contract renewals or obtaining new government deals. This would be particularly problematic for business segments that may not be exempt from budget cuts, such as general analytics and surveillance software. Given that Palantir is already facing scrutiny over its elevated price-to-sales ratio of nearly 100 times, any disruptions in government revenue could further pressure its valuation, leading to increased skepticism among investors. Despite concerns surrounding its pricing, Palantir has benefited from strong support among institutional analysts, which has played a key role in sustaining its upward trajectory. In early February, the company's stock experienced a surge following the release of its fourth quarter earnings report. Palantir not only exceeded Wall Street's expectations, but also provided a strong forward-looking outlook, reinforcing investor confidence. Among the major financial institutions backing Palantir, Bank of America recently reiterated its buy rating on the stock while increasing its price target to $125. Analysts at the firm emphasized the company's unique value proposition within the artificial intelligence sector, arguing that Palantir is well positioned to drive innovation and enhance decision-making processes. The company's ability to operationalize large-scale data is seen as a critical advantage in an increasingly competitive technology landscape. Similarly, Morgan Stanley has revised its stance on Palantir, upgrading its rating from underweight to equal weight. In addition, the investment bank raised its price target to $95, citing the company's continued expansion in both commercial and government sectors. Palantir has now achieved 6 consecutive quarters of accelerating growth, a testament to its ability to capture market share in key areas. This sustained performance has strengthened investor confidence and contributed to the stock's ongoing momentum. While institutional analysts have largely maintained a favorable outlook, hedge fund managers appear far less enthusiastic about Palantir's prospects. Despite its prominence within the artificial intelligence industry and its strong presence in the defense and commercial sectors, many hedge funds remain skeptical of the company's valuation. Data from TipRank's hedge fund tracker indicates that top-tier hedge fund managers currently hold a low-confidence view of Palantir's stock. Based on 13 F filings from 488 hedge funds submitted to the U.S. Securities and Exchange Commission, institutional investors have significantly reduced their positions in Palantir since mid-2024. Hedge fund holdings have declined from nearly 24 million shares to approximately 12 million shares, reflecting an increasing lack of confidence. Analyzing the sentiment of 24 leading hedge funds, the current confidence rating for Palantir is categorized as very negative. Wall Street analysts remain divided on whether Palantir represents a strong investment opportunity at its current valuation. The stock currently holds a consensus rating of hold, based on a combination of 4 buy ratings, 9 hold ratings, and 5 sell ratings over the past 3 months. Analysts have set an average price target of $93.13 per share, suggesting an upside potential of approximately 4% over the next 12 months. In the end, Palantir Technologies has established itself as a leading player in artificial intelligence and data analytics, with a strong track record of growth. However, its valuation remains significantly elevated compared to industry standards, leading to ongoing debates about its long-term sustainability. While institutional analysts continue to support the stock and highlight its growth potential, hedge fund managers remain unconvinced. Additionally, the possibility of reductions in defense spending could introduce new challenges for Palantir's revenue streams, further complicating its financial outlook. Investors should carefully evaluate these factors before making any investment decisions. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.